Topic that Prem has given me gave me a lot of interesting anecdotes. I think the most important aspect of it actually came from the 96 to 99 period. If you look at the 1996 to 99 period, and luckily, including me, there were very few people who are involved in fund management in that period. And that period actually saw the death of value investing as a style. In that period, one of the most famous fund managers of today is a person called Seth Klarman. He runs a fund called Baupost, B-A-U-P-O-S-T. And he's a person who doesn't give interviews, who doesn't talk much to media. And he's known to be very low profile. But he has an investing track record which compares itself with Warren Buffett. So I was reading about Baupost, and what was very interesting in Baupost was that in the year 97, 1998 and 1999, in these 3 years, he substantially underperformed the benchmark. And when that happened, it would have been so difficult because for 3 successive years, 1997, 1998 and 1999, when you have underperformed the benchmark, it would have been pretty difficult. But he went on to hold on to his investing style. And with that investing style today, he has some of the best, he has some of the best 20-year track records in fund management anywhere in the world. So that was the importance of style. The second most important anecdote which came out of style was a famous topic in Barron's. The issue came out, Barron is like, the local, you can call it, today it could be called like Forbes or Fortune or Business India or something like that, Business Today, something like that. And in the Barron's magazine, the heading or the cover story in 1999 was that Warren Buffett is obsolete. And just imagine you're Warren Buffett and you've been investing for 40 years prior to 1999. And the topic in 1999, the heading was that Warren Buffett is obsolete. So what came out in that article was that Warren Buffett plays bridge with Bill Gates, but he doesn't know how to buy Microsoft stock. And that's why he's become obsolete. As you know, from 1999 till today, or from the time Warren Buffett started his career to today, he has one of the best investing track records. Luckily, I was not a fund manager between 97 and 99, and therefore, we didn't go through that phase. But I'm sure here, there are a number of people who have practiced, who have done mutual fund distribution and wealth management during that period. And you will realize that the 99-2000 phase, the kind of funds which were having the highest AUM, I think those funds have still not reached the AUM that they had in 99-2000, despite the industry being so much bigger than 99-2000. So that's what is really meant by style. I would actually say that, I will go through it in a more simpler way. Not talk about the kind of experiences people have had in 1997 to 99. And primarily, I would say that there are 2 styles which most of you know, which is value and growth. And the beauty of the value style is that you have to be, I would say, buying when things are a problem. And you will be buying when assumptions are very low. So what essentially tends to happen in value investing is that you are normally a bit lonely at the time you're buying. And if you can't manage the emotional problems of being lonely, value investing is a slightly different style. But what the world has shown through people like Warren Buffett and Seth Klarman and many others is that the best long-term investing style has been value in the world for a long period. So if you take a 50-year history, if you see the most celebrated investors, you will find that it is the value investing framework which has actually worked very well. On the other hand, if you look at what we in India think of value investing, people think it is buying cheap. Suppose I'm a value investor and in 2011 I saw all the infra stocks starting to come off and I started to buy them as part of the portfolio. I would be buying cheap, but I would not be buying cheap relative to intrinsic value. So what in India people think of value investing is buying cheap. But frankly, genuine value investing is buying cheap relative to a concept of value. And that people have to internalize, because people who just buy cheap, they may succeed, they may not succeed, but there would be a situation like what would have happened if you had bought all the construction stocks in 2011. Even after 4 years, many of the infra-related players have done very badly. So that's the most important, and the job of trying to identify intrinsic value is the reason why we have fund managers and the reason why people like us have jobs. So contrarian investing is again a subset of value. And on the other hand, growth style is something where you actually look at assumptions, you look at the growth. So for example, if you see India's leading technology company, it was growing very fast. With every quarter of growth, it actually kept on going up. But what happened is when there were just 1 or 2 quarters of growth, today the India's leading technology company trades at almost the same valuation as another company which was hated for low growth because it was growth investing. So in growth investing, people will keep giving you higher multiples only when you have more and more growth. And you need the right attitude as a fund manager. So if you see, for example, capital goods stocks in 2007, it was a growth sector. But you needed to identify the time to exit capital goods when growth slowed down. That is a much more difficult art. Whereas in value investing, while you're buying when everyone else is selling, you get an advantage that, normally you will have no problem because you're actually trying to buy after a fall and not have to sell at the top. So even if you manage to keep on buying things cheap relative to intrinsic value, it's a very, very attractive investing opportunity. So India, for a long period of time in India, people kept telling me that growth style only will work. And in 2007 was a year where in India people felt that growth style is the only style. But we believed always that it is not just growth style, growth and value both will work. And what Warren Buffett says is that growth and value investing are both joined at the hip. And you have no style is very pure. Finally, at the end of the day, the goal of every fund manager is to create alpha. And you have styles which are in between the two. And like, for example, growth at reasonable prices and good in-between strategy, which we think in ICICI Mutual Fund is the right strategy for the entire fund house. We may have value house, we may have value funds, but we believe that growth at reasonable price works best in a country like India. Now, why should all of you know about style? People should know about style is primarily because a particular style may fail in the short run. To give you an example, Warren Buffett or Seth Klarman were not bad fund managers. They're the world's best fund managers over a long period of time, running into decades. But because their style of investment failed between 97 and 1999, people got this feeling that they were not good fund managers. So a style, it is impossible for anyone to say what style will work in the short run. I mean, people can think that they will think, like today, for example, we think that growth is a style which will work now. The reason is that we believe India is going to have much more growth from now on, and that's our belief. But if you look at it, it is never clear, and there is no way we can say which style will work in the short run. And what we've seen, and if you look at the history of value investing in India, in 2007, people lost their patience. And most people, as you would have known, there were so many people who had products which were all called value-oriented funds, but they all did not push the products subsequently after 2009. Because in 2007, they lost confidence in value investing. So I think that a wrong time to redeem is very clearly when a style has failed. And when that style fails, in 2007, extreme growth investing worked. Not GARP, extreme growth investing worked, but that was the wrong time to invest in extreme growth investing. If you go and see in 2007, the fund houses which did the best or the schemes which did the best, those are the schemes which almost don't exist at this point of time. The reason is that, every style also goes through a cycle. So, this data, unfortunately, we try to look for what can show you the difference between growth and value investing. The surprising thing we found was in 2007, the MSCI value index for India outperformed the growth style. But if you see the 97 to 99 period, clearly the growth style had done very well compared to the value style. But the same data I couldn't get for 2007, sadly. But as you can see, there are times when value style works, there are times when growth style works. And in my opinion, both styles are likely to deliver returns over the long run. And it is not only the growth style. So what should the distributors or the wealth managers do? In my opinion, if you ask me, the biggest thing would be that every style will go through a cycle. So there'll be a style like value which will fail in 2007 and succeed later. And if you are able to understand what style the fund manager follows, it would actually help them in suggesting the best possible fund. And every style will go through a cycle, whether it is growth, whether it is value, whether it is extreme growth. And in our opinion, the most important thing is that all these investing styles mean reward. So if you are stuck in a wrong style, if you are managing to stay with that style, you're likely to get a good experience. But maybe I'm a value guy and I'm a contra guy, so I would always say that the best time to invest in any style is when it has not performed well. And so, for example, if I see a period where value investing does very badly, I would say that would be the best time to invest. If there is a period where growth investing has done very badly, that would be a time to invest in growth style. And what is the biggest job for us as fund managers is we should not switch between one investing style and another. And it is what we in our house call it as changing fund strategy after failure. So those people who have changed fund strategy after failure, they've had the most miserable experience. As long as you stay committed to a style, you will not have this problem. So if you go to 2007, and you had looked at Discovery, you would have thought, boss, can value deliver? But if you look at the last 10-year returns today of Discovery, which includes 2006-07, it's an absolutely fantastic situation. So I would say that you should just taste to the style, but there is an effort involved here. You will have to talk to the fund manager. You will have to understand from him what is the style he follows. And over a period of time, you should realize whether he is sticking to the style. And in India, we don't have too much of institutional money in equities. In the world, what people do is, people ask, well, there is something called style drift. So what they do is, when you have institutional money, if you do style drift, they normally redeem. That means if you have actually told people you will follow a value style, and after some time you show that you're doing growth style, then automatically it means that you're doing style drift. So, you have to explain your style to investors. And what we as a fund house try to do is try to explain to people what kind of strategy we follow, Obviously, like Warren Buffett says, there's nothing called, it's not black or white, it's sometimes gray, but it's very useful to see a style. If you see the top holdings of a fund manager, you'll get a good idea of style. And if you, over a period of time, you watch the top holdings, you will get a reason whether what kind of style he uses. If the top holdings are actually the best performing stocks in the market, normally it would be the growth style. If the top holdings are stocks which normally people don't hold at the top, it would be something like a value style, because those would be companies which are having trouble. So I would say that it's very simple as long as you are able to understand the fund manager and his style and you stay. And as I mentioned, the best time to invest in any style would be when it has not performed well, not after it has performed well. And that I find very difficult for Indian people to actually think about. So today, for example, if you leave aside the growth and value style, today people are very fond of small caps. But if you go back to 2013, no one was willing to look at small caps. And that was a big problem. At that point of time, small caps were extremely interesting. So I think the most important point that you will have to remember is that all these things operate as cycles. As Howard Marks says, there are times when the best quality companies may be very, very dangerous to invest in. And there'll be times when the worst quality companies may be the best stocks to invest in. So that's what we have to basically take care of. That's broadly what I wanted to convey. I'm happy to take up questions if there is time.
Okay, now, Naren, one of the things that puzzles me is why are very few fund managers willing to identify and label themselves as following a style? You are one of the very few fund managers. I can only think of one or two other fund houses which have products which are labeled. Why is that so?
See, in India, it was considered very dangerous in 2007 to identify with value. It was considered much more safe for you to identify with infrastructure. So what happens is when you label yourself as a particular strategist or a particular style, what happens is you will have to also accept that there will be periods of time when a particular style will fail. And, people in India think that fund managers are superstars. They are not. So they will go through their down phases. They will then, at the end, they will go right as long as they stick to what their core competence is. So I think a lot of people in the pre-2007 phase, people believed that there will be something, they will always be able to deliver returns. I had a view which was slightly different. And for example, I believe that in the short run, it is impossible to be consistent. And anyone who claims that they will be always consistent in the short run would be a person like Madoff, who gave very, very consistent returns in US for a long period of time, only to discover that the returns were bogus. So I believe that it is more important to follow a style. And what the experience of the global investors like Warren Buffett or Peter Lynch, who followed a growth style, or Seth Klarman and John Neff, there are so many global gurus. All of them, what they have shown is you have to create a style and you have to follow it. And as we manage larger and larger sums of money as we are doing today, in the industry, it is very important to have a style. Of course, if you're managing 250 crores or you're managing 500 crores, the style aspect is not so important because you can change style. If you're managing much larger money, it's very important to follow a clear research process and fund management style.
A couple of more questions for you. Do fund managers combine value and growth styles in same fund? This is a question from Saurabh Bajaj.
Yeah, I think they do. Actually, as I said, there is nothing called completely pure. And it is joined at the hip. So people follow a combination. But over a period of time, if I looked at a portfolio of a fund manager who's run money from 2007 to 15, I'll be able to determine whether he's a value style fund manager or he's a mixed style or a growth style fund manager. And I believe that the most successful fund managers in India over the next 5 years who manage large AUM will have to create a style and adhere to that style and be willing to take the pain in the short run for their style not working.
Which style do you think will work well in current market conditions?
See, as I mentioned, my personal belief is always in the 5 to 10 year segment. I would always believe that value investing is the best style. But if you look at a 1 to 2 year segment, if you look at it, value has done very well in many of the strategies over the last 2 to 3 years. So to us, somehow it looks that from a shorter term point of view, it does look that growth looks much better because there is no dirt cheap areas of the market except junk stocks at this point of time or a few public sectors. So what happens is, if you want to make money in the long run, value investing always works. But in the short run, we are a bit more positively inclined to growth investing.
One last question. PSU stocks, especially banks, have massively underperformed in the last few years. Your comments on how long do you think they will take to revert to mean?
See, actually, that's where this the classic problem of value investing is what is the intrinsic value of some of these banks. And in our opinion, as the economy picks up and many of the infra companies actually come out of problems, actually the intrinsic value of many of these banks would go up substantially. But what has happened in the phase after July, particularly after the coal case happened, is that a number of companies which are even better have come down after the coal case verdict came. So somewhere the intrinsic value increase other than on their treasury book of government securities has actually gone down. And the last quarter's results in public sector banks again caused the same problem because the NPL problems are not getting resolved in a hurry. So that's why I would say I would wait to see if there are some infrastructure companies which come out of their problems. If they do, I think definitely the intrinsic value of public sector banks will go up substantially.
So, wonderful presentation, Naren. Let's give a big hand to Naren.
Thank you, Naren. I would now like to invite our next esteemed guest, Mr. Ravi Gopal Krishnan. Ravi heads equities for Canara Robeco. He has over 22 years of experience across different segments in the industry. Ravi has done his MBA from the Bradley University, USA, and his master's in finance from Drexel University, USA. Ravi, please take over.
Good morning, everyone, and thank you very much. As an introduction, I think in terms of the subject, asset allocation, I think we all heard about it, discussed about it, but unfortunately, very few people implement. So we thought, maybe it's a very pertinent subject for all of us here to follow. And, some of the data, some of the anecdotes that, probably is mentioned in this presentation, will actually tell us, how important asset allocation is, from a long-term investment perspective. So, in the next 10 to 15 minutes, 15, 20 minutes, what I'm going to talk about is actually how do Indian equity investors look at, basically a lot of influence is on markets and the market performance, etc. There's a lot of emotions involved in equity investments. We will talk about a holistic approach to equity investment and also how do we invest without bringing the emotional part of it. Because we see a lot of volatility in different asset classes, etc. And the general tendency is to chase the returns, the hot asset class as we would. So let's look at, briefly the current investment pattern, By and large, if you look around, Indian investors are underinvested in equities. in fact, not only Indian investors, I have some data which also points out that, across the world, there are some geographies where, people are underinvested in equities. And equity investments, unfortunately, is regarded more tactical as opposed to strategic. We all know that, right? 2013, nobody wanted equities. 2015, everyone wants equities. And greater emphasis on products. We dwell on products, which product to choose, which is the right thing. A lot of time is spent on products rather than setting a goal and then working towards, what are the right products for me. And there are a fair bit of gaps in terms of investor risk profiling. I think, your role as advisors is extremely important for mutual funds, distributors, and investors to actually succeed in terms of the right risk profiling. So what do I mean by holistic approach to equity investments? Let's look at the equity holdings of investors across the globe. What does, equity, it is actually determined by social, political environments, different, experiences, right? If you look at the US example, US investors have roughly 45% allocation to equities. And the reason for that is, a lot of these are done through 401ks, their pensions, et cetera, et cetera. People, if you ask a US